Here's a problem nobody warns you about. You need a credit card to build credit, but you can't get approved for a credit card without already having credit. It's a genuine catch-22, and it stops more people than any actual financial mistake ever does. Not because they did something wrong, but because nobody explained the actual way around it. By the end of this video, you'll know exactly what your credit score is built from, the precise starting points that work with zero history, and the step-by-step order to build a strong score from nothing. Part 1. What your credit score is actually built from before fixing anything. It helps to know exactly what's being measured. The most widely used scoring model, FICO, breaks your score down into 5 weighted categories. Payment history, 35%, whether you've paid your bills on time. This is the single largest factor by a wide margin. Amounts owed, 30%, primarily your credit utilization. How much of your available credit you're actually using. Length of credit history, 15%. How long your accounts have been open, including the average age of all your accounts. New credit, 10%. How many accounts you've recently opened and how many hard inquiries are on your report. Credit mix, 10%. Whether you have a mix of account types like a credit card and a loan rather than just one type. Notice what this means for someone starting at zero. Payment history and credit utilization alone make up 65% of the score. And both are entirely within your control from day one, regardless of how short your history is. You don't need a complicated mix of accounts to build a strong score. You need consistency on the 2 factors that actually carry the most weight. Part 2. The exact starting points. With zero history, there are 3 realistic entry points. A secured credit card. You put down a refundable deposit, commonly $200 to $500, and that deposit becomes your credit limit. Because the issuer holds the deposit as collateral, approval doesn't require existing credit history. Used correctly, it reports to the credit bureaus exactly like a regular card, becoming an authorized user. If a parent, partner, or close family member has a credit card with a strong payment history, they can add you as an authorized user. Their account's history can begin appearing on your credit report, sometimes immediately. Though it's worth confirming, the specific card issuer reports authorized user activity, since not all of them do. A credit builder loan, offered by many credit unions and online lenders. Unlike a normal loan, you don't receive the money up front. Instead, you make fixed monthly payments into a locked account, and the full amount, often minus a small fee, is released to you once it's paid off. The payments themselves build your payment history in the meantime. Any one of these is a legitimate starting point. A secured card is generally the most direct path, since it functions exactly like the credit card you're ultimately trying to build a history toward. Part 3, the step-by-step build order. Step 1, open a secured credit card or get added as an authorized user, whichever is available to you first. Step 2, use the card for 1 or 2 small, predictable expenses each month. Something like a streaming subscription or a regular grocery purchase. The goal isn't spending more, it's generating consistent, trackable activity. Step 3, set up autopay for at least the full statement balance every single cycle. This directly protects the 35% payment history factor and removes any risk of a missed payment from simply forgetting. Step 4, keep your utilization low. Ideally well under 30% of your available limit and under 10% if possible. On a $500 limit, that means keeping your balance under $150 and ideally under $50 at the time your statement closes. Step 5. After roughly 6 to 12 months of consistent on-time payments, check whether your secured card issuer offers an automatic upgrade to an unsecured card. Many do, returning your deposit while keeping the same account and therefore the same account age intact. Step 6. Once you have one account with a solid track record, consider adding a second account type, such as a different unsecured card or small loan, to begin building toward the credit mix factor. But only after the first account has a real history behind it, not before. Part 4. The numbers that actually matter. 2 numbers deserve special attention because they're easy to get wrong even with good intentions. Utilization is measured at your statement closing date, not after you pay it off. Many people assume that paying their balance in full each month means their utilization is always near zero. But if you charge $400 on a $500 limit and the statement closes before you've paid it down, an 80% utilization can be reported to the bureaus, even though you fully pay it off days later. If this matters to you ahead of a major application, like a mortgage, consider paying down your balance a few days before the statement closing date, not just before the due date. Average account age matters more than people expect. This is exactly why closing your very first card later, once you have other accounts, is usually a mistake. Doing so removes your oldest account from the average age calculation and can lower your score, even though it feels like a harmless cleanup decision. Part 5. 5 mistakes that undo months of progress. Mistake 1. Closing your first card once you don't need it anymore. As covered above, this can shorten your average account age and hurt your score, even years into a strong credit history. Mistake 2. Applying for several cards in a short window. Each application typically triggers a hard inquiry, and several in a short period can both lower your score temporarily and signal risk to lenders evaluating you. Mistake 3. Maxing out a card even if you plan to pay it off immediately. As covered in Part 4, the reported utilization can spike regardless of your actual intent to pay it off. Mistake 4. Missing a single payment, assuming a few days late doesn't matter. Most issuers only report a late payment to the bureaus once it's 30 days past due. But once that threshold passes, it can meaningfully damage your score and stay on your report for years. Mistake 5. Co-signing a loan for someone else without understanding the full risk. A co-signed account appears on your own credit report exactly as if it were your debt. If the other person misses a payment, your score takes the hit too, with no direct control over their behavior. The credit catch-22 feels impossible from the outside, but it has exactly 2 or 3 real entry points. And from there, the entire system rewards one simple behavior pattern: small, consistent, on-time use of credit you can already afford. So here's the one action. This week, open a secured credit card if you don't already have one, set up autopay for the full statement balance, and use it for exactly one small recurring expense. That's the entire starting move. Everything else in this video is just maintaining it correctly. If this finally explained the part nobody tells you about credit, subscribe. Next video walks through exactly how to read your full credit report and catch errors that could be quietly hurting your score.